our level of inflation is going to be higher. That 2% is a pipe dream. I mean, if you're going to own some bonds, you better own some gold right beside it, I think, if that's what you have to do. But I just think owning, if a person says, I'm going to own a lot of bonds more than 5 years out, 10, 15, 20, 30, I really think they need to rethink that about where the country is today.
Ted Oakley, managing partner and founder of Oxbow Advisors. It is so wonderful to welcome you back to the show. Great to see you as always, Ted. We always appreciate you coming on.
Thanks, Julia. Good to see you again.
I'm thrilled to see you. And I got to say, Ted, the last time we spoke, I feel like it was probably late April, early May. It's been a while. And we have you here today on the Friday, September 5th. We just had the jobs report this morning. And since it's been a while, had a lot happening this summer. Let's start where we always start, Ted, with more of that big picture, where we are today, how you're thinking about the economy and the markets, your outlook, if you will. And as you know, Ted, on this program, you can take all the time you need to set the table when it comes to that big picture view.
Well, Julia, you know this, but we do mostly bottom up on the investment side as far as finding things. But I will say this to you. 4 months ago, we were coming off that low and we were rallying up, and typical, everybody's been trained to buy the dip. And so it worked again for them. But we were expensive by the time we got to June, but now we're real expensive. Now, what does that mean? That means you're selling at 23 times future S&P earnings, not past, and 26 or 27 times trailing 12 months. And under any circumstance you want to look at that, S&P 500 dividend, for example, is only one other time. There's only been 2 times when the S&P dividend was 1.2%, which is virtually nothing. And so when you get all this, you put all those things together, there's a lot of things going on, by the way. You look at delinquencies rising, you look at home prices are stuck. And you can see those little signs out there. You could see them before, but now I think they're having a little bit more impact. But I just think from an economic standpoint, you'd have to say we're flatlining at the very, very best. But that's sort of how we see it right now.
Yeah. So as you point out, you're starting to see some of these signs out there, the little signs, and the economy is flatlining. It makes me wonder, Ted, is there a bit of a disconnect between maybe what's happening in the economy and then what we're seeing in the markets?
Oh, totally. Yeah, what happens is, this is not anything new, but when people are making a lot of, they make good money in the markets, and they don't want to get out. So they don't really, in the economy, you could be giving them bad numbers, and if they look up the next day and the S&P is up a little, they're fine. They never think about it until they wake up one day or after a series of weeks, and all of a sudden, hey, I've got 15 or 20% less than I had. And then they think about it.
Yeah. When you look at the markets as someone who's been, how many years? I think 45 years now in the business. What do you make of it? Does it make sense to you?
Well, it's a few more than 45, but I'm not going to go too much detail, but it's 48 or so. But the point being is that nothing really changes in people's emotions. All this period of time I've been in the marketplace, it's always the same. At lows and at highs. At lows, they're so distraught they want to buy anything, which is kind of, obviously odd if you're really in there to make money. And at highs in the market, they don't want to sell anything, because if they sell it, they're afraid, it's going to go higher. And usually it would if you sell a little bit, but no, it's not a lot. That the emotional part of it's not a lot different. I would say AI to me is sort of like the build out of the internet was in 98, 99, early 2000. They overbuilt it. And then 2 years later, everybody had to eat the CapEx and realize that, hey, we're not making any money here. And I think the same thing's happening in AI. It doesn't mean that AI won't do well. It just means that too many people ate the fruit. And so then some of them get sick And I think that's where we are, but it's not a lot different than a lot of markets. They're very similar in terms of greed and fear. I'll put it that way.
Mm-hmm. I want to also bring up the Fed with you because I think now everyone's kind of expecting, it's pretty much a lock-in that we're going to see a rate cut in September in just a couple of weeks when they have the FOMC. So how are you thinking about the environment for a rate cut, what that might mean? How are you thinking about that?
Well, in the big picture, and I'm talking about the next 5 to 10 years, we think our level of inflation is going to be higher. That 2% is a pipe dream. I mean, we're probably, it may not mean you go back to the late 70s, but what it does mean is that when you get these periods when they lower rates, and this could be an Arthur Burns kind of period like the 70s, where they should not be lowering rates with full employment, a lot of things going on. And they're probably late on rolling if we're really going into recession. But now they become political, which is what they were in the 70s, by the way, until Volcker came along. And he basically told President Reagan, hey, I'm not doing what you want. And so we're back into this mode again. And I think by lowering rates, and I mentioned this, I remember 4 months ago when I interviewed with you, I mentioned that you're probably going to get a chance. Rates going to go down somewhere in the next 2 or 3 quarters. And if they do, you're going to get a chance to sell those long bonds. You need to sell them, okay?
Mm-hmm.
Don't get caught up in this idea that we're going back to a 0.5% or 1% interest rate. And oh, by the way, if we do, this market's down 50%. I don't think either one of those are going to happen. But the main point is that if you get a chance to sell this bonds, you should sell them because there's really nothing there for it. If you think about a bond, like a 10-year bond, it's maybe a 1.2 over inflation right now, and that'll be a small period of time. We think the way this government's run, the way we're printing, the way things are going, the only way out of this has to be you print it out, and eventually you can't loan long bonds in that situation. But I will tell you, Wall Street keeps selling them, and people keep buying them. But from a Fed standpoint, you'd have to think, hey, this thing's a real mess.
Yeah.
I mean, just think about it.
Okay, I do want to hear a bit more. Okay, that's going to give you a window or an opportunity to sell those long bonds. Elaborate a bit more. Is that because we will likely see, more mounting government debt, the rising interest expenses, like persistent inflation? Is it like the stagflation threats? Give me a bit more color.
I don't know if it's stagflation as much as if you look at the new bill they passed, $5 trillion debt moved it up. So nobody's worried about the debt limit right now. And then they go in a situation where neither party, anywhere, even state and local, nobody's worried about balancing budgets, spend it, raise it, borrow it, spend it. And there's not much of a way out of that. I mean, you can say, okay, there's nothing you could cut. I tell you, my friend, and your friend too, Luke Groman, has a lot to say about it. What are you going to do? Well, nothing, because you can't. Some of the things you cut, you're immediately out of office, and so to me, what happens is they just keep on doing the same things. What that means, though, in the long run, is if you own bonds, if you're going to own some bonds, you better own some gold right beside it. I think, if that's what you have to do. But no, I just think owning, if a person says, I'm going to own a lot of bonds more than 5 years out, 10, 15, 20, 30, I really think they need to rethink that about where the country is today.
Mm-hmm. I wonder too, like, how many people even realize like how many people actually realize like what their portfolios look like and their like allocations in this environment?
Well, they don't.
Yeah.
You're right. If you go ask, and I've done this numerous times, I've had people that a lot of money and ask them what's in that, what do you have in that exchange traded fund or bond fund? What do you think's in it? Well, it says, that's all. It starts out with a sentence like, well, it says X.
Mm-hmm.
I said, yeah, but do you really know what's in it? You really know, how far out they go, and so, no, they don't know. And they, by the way, anybody sitting in the last 3 years is on long-term, they're so far underwater that they're not probably going to get even on this move in bonds. But if you even get half of that move back or more, I think you should take it.
Mm-hmm. Yeah. Okay. So let me ask you this. With the rate cut, do you think that would, I heard you say it would be like a mistake, like an Arthur Burns mistake. Is it going to, in your mind, will that just fuel more inflation then?
Well, I think what it would do is maybe have people buying the market a little bit on it, but see, it won't affect the 30-year rate. I mean, and if that's the case, if you're looking at 20 and 30-year paper yields staying higher or going higher, then that's the marketplace telling the Fed, hey, this is not going to work for you because inflation, long-term inflation is still there. And they can lower them on the short run. But I mean, let's just say, I'll give this example. Say they lower them 50 basis points. All right. That's going to take the prime rate at a bank from 7.5 to 7. Is that going to cause a tremendous amount of borrowing? I doubt it. I mean, you have to get into some rate structures that make things really palatable or be able to make money out of it. Maybe you go into a recession and, they lower you have the rates come down, you bring the Fed funds rate on down, 2 points. I really don't think you'd bring them down more than 1.5 at the best, just because they've got too much inflation coming at them. Eventually, they will.
Mm-hmm. I have a pretty basic question, but like inflation, I have many guests who say this is still going to be a problem. Can the Fed actually really do anything to solve inflation? Can they really get back to 2%?
Well, can they get back to 2%, you say?
I don't know. I don't even know if that's realistic.
Well, no, what they can do with inflation is what Volcker did, which is you move the rates up so high that you're in a recession and you slow everybody down because the game's up. That's what he did. He pushed them up to, you could get just under 15% on a 30-year U.S. Treasury bond. Well, and that was 3 or 4 points over inflation at the time. And that was the perfect investment at the time. And yet, nobody would buy it. You think about a U.S. Treasury, they can't call it away from you. It's not like a normal bond after 10 years. So you could have made a 30-year investment that would have beat every stock market investment out there. But individuals, no, I'm not going to buy that because I can buy a 90-day CD that'll give me another point higher than that. That's how people think. But yeah, they can impact it. They can impact it if they want to get aggressive. I don't think they'd ever do it, but they could impact it.
I didn't ask you, but what were your thoughts on the jobs report and I guess more of that softer labor market data that we've seen come out? Love to get your take there.
Well, I do think the immigration situation's having some impact because it makes the rate look kind of okay or maybe different. But if you look at jobs in general, though, they're coming off. I mean, we keep revising and that sort of thing, but we're certainly not in a move today that would make you think we're in some sort of robust move in this economy, for sure.
Gold keeps setting new all-time highs, but price appreciation isn't the only way to profit from owning gold. Monetary Metals is redefining the future of precious metals investing. Instead of paying to store gold, imagine getting paid to own it. With Monetary Metals, you can earn up to 4% on your gold, paid in physical gold. That's right, your ounces grow each month, not just your paper balance. A yield on gold, paid in gold, means you're stacking more ounces every single month. And you still benefit if gold's prices rise. You're earning more gold every month and enjoying potential price appreciation at the same time. Go to monetary-metals.com/Julia to learn more and see how you can start earning 4% on your gold, paid in gold. Do you think when you look at the economic picture, you see, I don't know if you want to call them like warning signs, but you're talking about like the little signs that you're starting to see. Do you think we're like due for a recession? Has it been surprising that we haven't seen one in a while? What do you, I don't know. Like, will we see one
Well,
anytime soon?
yeah, when I think about a recession, I think about when the average person gets hit, pretty hard. Now, uh, yeah, you could. I don't know what the Fed would do about that in that case, and maybe they do another one of these overkills where they push so much money in that ruins everything again. But hopefully they'll realize this time around that if they do that in the long run, it's going to be tough. But yeah, it wouldn't hurt to have a recession, really. We've got so much fluff in the system, leverage, super leverage in the system right now. That wouldn't hurt to clean it up a little bit.
Yeah, maybe a bit of a reset or something. Yeah, it kind of feels like folks like are always looking for like some sort of move from the Fed to do something, and I don't know. Maybe we should just like let things actually play out. Well, okay. One of the other topics I wanted to bring up with you, because we talked about this with so much overexposure to stocks. I know we've talked about that, but we've also seen of late a lot of retail investors piling into the markets. There's also been a conversation on this channel about the passive bid and impact on markets too. What do you make about like just more of the activity that we've seen? And I'm talking more about like the stock equity markets. What do you make of the activity that we've seen there?
Well, a number of years ago, when you went to zero commissions, there's two things happen. You went to zero commissions, and then you changed from eighths, quarters, and half-point spreads to like 1 penny. So if you think about that, if I'm a little trader, well, now I've got a little machine here where I can make a couple $100 on a trade, or lose a couple hundred in that matter too. But so what's happened is, especially with people under 40, okay, they really think they've found some sort of holy grail, and it never ends well for them. The thing that works for true investment is to own a producing asset for a long time. That's how you make money. And for these investors that are buying all these daily options and all sorts of trades and all the cryptos and all that sort of thing, when those things break down, they typically take a lot of people with them. And I suspect that will happen again somewhere. And the individual, put it this way, Julia, if you open up at the Ford's 400 every year, you're never going to see anybody that says, hey, I made a lot of money trading the index every day or on crypto. Now, you can. That's my point, is that most of those people on there are own real estate companies. Some of them are in finance too, but the main point is that individuals are usually the last group to get on the train and the last group, unfortunately, to get off, because I've seen this too many times. But we'll see. I mean, individuals today, if you talk to them about selling part of their Apple or part of their NVIDIA or something like that, I mean, they're not going to do it. You might as well, I'll take your firstborn child, because they've made a lot of money and they don't want to listen to you. That's fine. It's their money. Do what they want to do.
Yeah. I wonder, would that be a bit of a warning sign though? Because I think that's probably happened in prior cycles too, where it's always that individual investor is kind of like you said, they're the last one, I guess, in, and yeah.
I had, it's interesting you saying, see, by late 90s, like particularly 99 and early 2000s, there's about 2 years there where everybody became a day trader.
Mm-hmm.
And they were quitting their jobs. I knew lots of them. They were quitting their jobs, and they were saying, this money is too easy to make. I'm pretty much set for life. I work 2 hours in the morning, and then I'm gone. Everything's fine. Well, fast forward 3 years later, and they're all gone. And what happens to that is, if you have some really poor times, and it goes the other way on you, they don't really have enough money to really stand hard times. And so a lot of them just lose it all. And, you can see what happens, but I've seen that before. Yeah.
Yeah. That's a good point too. Like, especially if you're like, oh, I made more money in the market today than I made at my job. And I guess most folks wouldn't even know like when to get out or get out at the right time and look for that moment to, get some liquidity. Ted, you and I have talked about the importance of liquidity, having that cash. How are you thinking about liquidity today and how much you want to have?
Well, you have to look at, you have to decide, okay, what your situation is. If you're over 60 or over 70 or so, you're in a different situation than somebody that's 30 years old. And so, because 30, you're going to continually put more money in a 401k. You're going to put more money in the market in your personal account. But most people in their 65, 75, 80, they have all the money they're going to have. That doesn't mean there's not a lot of it, but they're in a different situation that they need to keep enough liquidity so that they can have some peace of mind under any circumstance. This is where I come from. And you have to think about what's right for you. I'll give you an example. Let's say the S&P is up, 10.5 for the year, 10, 11 almost. And you have an account, which we have some like this, that are up 8% or 8.5%, but they have 50% in treasuries. Which one of those would make you feel more comfortable? The one that's fully in every minute, every day, and has no buffer, or the one that's doing okay? It's not some sort of race here, but you've always got some safety valve. And the main thing we do is we look at companies, and I'll tell you, it's just not there. I mean, if we had a lot of cheap companies, we would buy them, but we find some good things. I mean, some of the new companies we found in the last 3 months or so, if you take if you take everything they have to spend, capital expenditures, debt, everything, and the cash is left over, their free cash flows are 9, 10, 11%, which is really good. But see, there's not many of those. That's the problem. And so right now, I think when you ask a question, what's right for you? Here's what's right for you. If I come in tomorrow and let's just say, forget about what happens, and I'll compress it. Say it's a 3, but I'm going to compress it to 1 day. And your portfolio is down 35 or 40%. Dollar amount, think about it. If that really unwinds you and you can't deal with that, if you think if that really happened, I don't know what I would do, or I'd be going crazy or whatever. Ask yourself that question. So if you don't have that staying power, then you need to raise some cash and have some liquidity, because you're playing a fool's game in that every so often you have a major sell-off and you'll have another one. And so if you're not ready for it, then it doesn't work. And I'm not doom and gloom here. I'm just trying to tell you have to manage your risk. That's the key to investing. You have to manage risk. I mean, one of the things we espouse at Oxbow is we're never going to lose a lot of money. And we don't necessarily at the top. And if somebody leaves us, they usually leave us because we weren't as aggressive as they wanted us to be, but we own the right stuff, So I think people have to, that's how you think about liquidity. And I see it today. A lot of people, 70, 75, 80 years old, I'm like, you're not even counting the fact you might get sick. I mean, there's all kinds of things. See, we're fiduciaries. So if somebody comes to us and says, hey, I got a lot of money, but I'm 80 years old, but it's 90% in the market, we won't take that account. Because, next thing could happen. I mean, I can't make a case for that person. If they're 25, I can.
Right. Y'all manage the money of like a lot of high net worth individuals, a lot of people who've probably had exited businesses. They've been really successful too. And I imagine, Ted, it's like preserving that wealth, growing it at a steady rate versus like these big, crazy, like, swing for the fences kinds of moves. Y'all are looking for like, how can you steadily grow that, preserve that? Is that right?
Oh, for sure. I mean, we have so much of our business over the years because we write books about it. We've done many, many speeches over the years about people that have sold a company. And the one thing about it is they know what they sold it for. If you sell a company for $50 million today, net after tax, you know you have $50 million. And it's not it's not best for their mental health to show up 2 or 3 years later and have that 50 be worth 35 or 40 because they're like, well, wait a minute, that's not what I thought was going on here. But I think a lot of them have sort of forgotten that a little bit, and they've gotten further out over their skis than they should be. But in general, I see it, and you get into these. We manage in some family offices and foundations, different things, and I think these consultants have convinced them that, oh, you got to keep swinging for the fences, and we're like, no, you don't really. What you have to do is make a few percentage points over the inflation rate, maintain buying power, and you'll be great for the rest of your life.
Yeah. It makes me wonder too, like, when you see like double-digit stock returns in like more recent years, do people just get like a recency bias and they think, oh, I need to be doing that every single year or something, versus like maybe just the steady, like you said, a few percentage points above the inflation rate, you're good to go.
I have a graph that we put together a few years ago. But if you had 5 years in a row where you made 15%, and then you have 40% or 50% sell-off, you go almost back to break even.
Oh, wow.
People don't realize what losing money does for you. It's not the gaining, it's the making sure you don't lose a lot. It's not going to say you never lose any, but you need to keep that manageable, and that's what will get you through to make sure that you'll be all right over every single year.
It's a good point. Yeah, I really liked that framework you shared though, and like asking yourself like how much liquidity you need. I do want to ask you this because it's not like you're not finding opportunities in the market, but how are you finding like these hidden gems, if you will? What can you share there? Like what are the opportunities today? You don't have to go into too much detail. I don't want you to give away all your secrets or anything, but anything that you can share, that would be great.
Oh, sure. We screen about 300 stocks or less that are good companies. We wouldn't mind owning them. In other words, they have low debt to equity, good management. They have a high free cash flow, meaning they have money left over to pay more dividends, buy back the stock, whatever they want to do. And sometimes you just have one. For example, Crown Company, which makes a lot of cans, okay? You see them.
Wait, what is the company again?
Crown.
Okay, Crown, okay.
Yeah, and, all of a sudden it gets in a position where it's got a high free cash flow, it's in a great pricing spot, and we look at those companies and what we think they can do the next 5 years, and we try to discount that back and say, okay, well, we'll try to buy it a little better than that price even. So we have some pricing points where we come in to buy, and that works for us because we're really going to try to own those companies if we can, 5 to 15 years, maybe longer if they're a really great company. But when we see a company that's coming into play like that, we know, like for example, now we've been buying some energy. Now you could say with things slowing down worldwide that energy is going to be in the doldrums. Probably is too, by the way, for the next 6 or 9 months. However, if you look at production and the way things are set up, energy is probably one of the best buys out there for the next 3 to 5 years. And you let oil go up to say 75, 80 bucks or higher, then you're going to bring it out of the woodwork and everybody will want to buy it. But you look at things that really make sense in terms of paying you interest, dividends, free cash flow, as you would own a business. We look at it like we would own a business. I mean, if you look at the gold miners we own, this is another strategy. We were in those way earlier than, well, people are still not in them if you want to get right down to it. People still don't believe in gold miners, but they were really cheap and we could see the numbers stacking up. And here's a group that's making a lot of money and probably will continue to do so. But until the investing public gets excited about it, they'll just do it right in front of them. But we screen things out to find a good bias, and if we find in a high income strategy, for example, we have to own things that are 5%. Try to own things that are 5% cash flow or higher. Mm-hmm. But we find them. It's just we don't find enough. If you look at the average treasury level for us, short-term treasuries, I mean less than 15 months. All three strategies, it's 50%. It's not because we wouldn't do it, by the way. We would, if we were cheap tomorrow, you'd see us bam, 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 buying companies. And I guess it's, kind of like Berkshire Hathaway in a way, not that we're anything like that, but you have to start looking at things that are like we bought, Cigna. Now, some of these companies get hit because they throw them in the pot with all the other companies, but that company's totally different. And they don't depend on what these other companies depend on. That sort of thing. Sometimes you'll get a situation, but you find things to buy, but sometimes you have to sell things too if they don't work out.
Yeah, it's like truly like getting into like stock picking, if you will, and looking for those opportunities. Did I hear you correctly? You said 50% across the three strategies in the short-term treasuries?
Right.
Is that normal or what's usually the allocation?
Well, we have this one strategy, conservative fixed income. Now that's normal for them because that's a conservative fixed income strategy, and everything we own in there is less than it's very high quality treasuries and short munis, but that everything's less than 48 months or 50 months, 60 months maturity, so it's always that way. But we do carry 6% gold in that strategy because if you're going to own any kind of bonds, you're going to need to own some gold.
And why is that? Can you explain that relationship, like wanting to own gold if you're going to own bonds too?
Well, it wasn't always that way, but it could have been, I guess. But now it's a situation of where a lot of trade that's going on with the people we don't like, necessarily, I'll use China as an example. They're having, at 1.2 trillion excess, and it's all in dollars. And so they'll go to another trading partner with us and say, hey, I know you got some debt over there. We'll flip that. You can do the yuan. We'll give you some dollars. You can pay that off. And so what's happening is they're getting away from the treasury, getting away from the dollar, and they're buying gold. And if that's the case, and I think all countries are in bad shape right now. If that's the case, you have to go back to hard assets. Now you can go any way you want to go. You can go land, building, farms, metals, mining, oil and gas, minerals, anything you want to put in that package. But I think that's why we put it over there, because it becomes like a currency to us, a hedge.
Interesting. Yeah. And look, gold today, I'm just looking, it's at a new 52-week high. Yeah. It's north of 3,600 or 3,653. Yeah.
Yeah.
Rounds.
To answer your question, on the stock account, we're about, with our leased, we're about 40, 42, 43% treasuries. Again, not because we were trying to time it or anything. It's just that we didn't have the companies that fit. And then we have very high income strategy. And believe it or not, it's about 60, but the things that we have in the 40 have done so well that it offset it. So, that's the way it goes.
Yeah. So it sounds to me like commodities, though, are going to be important because I heard you say energy, obviously gold, commodities being an important area for investors to be thinking about.
Well, if you go back, Julia, and look at a 25 or 30-year chart on the Bloomberg Commodity Index, you'll see we're lower than we were 20 years ago. And I think people have gotten so used to financial assets that they've forgotten that there's other things out there. So I won't be surprised that if in the next 10 years, if you get to the end of 10 years, that you'll look up and say, gosh, commodities did really well during that period. And they come and go. You can't buy a commodity and hold it 30 years really like you can a stock, a company, a really good company, because they come and go. Supply, demand, a lot of things hit it. But we're in a situation now where they've been beaten down so badly for so long that and that's why all of that whole group, if you look at, metals, mining, any oil, there's so many things fit that. And I think in times of higher inflation, commodities are always going to outperform.
Mm-hmm. Yep. Okay, so that's part of that trade, that inflation trade, having the exposure to the commodities.
Well, I think you do. I mean, for us, it's a lot of things, but we own fertilizer, timber, we own a lot of energy, metals, mining, iron, all sorts of things that fit that category. So, we'll see. And it's always a horse race. So we've been right the last year or two, but it's always, what have you done for me lately?
Exactly. Let me ask you a couple more questions before I let you go, Ted. I think this is your third appearance on the show this year. We had you at the beginning of the year, late spring. Now, as we're getting toward the end of summer, I can't believe it. But when you think about like the first 8-9 months here of 2025, has there been anything that, well, gosh, I'm sure there's many things, but what has surprised you the most this year that maybe has made you kind of readjust your thinking, if you will? Anything that stands out as like a big surprise for you this year?
Not a lot, really, Julia. Everything that we sort of thought the way things looked a year ago is sort of the way it is, or the way it's happened. And so that hasn't surprised me. I think the tariffs were different for us because we and everybody else have no way of knowing, what that outcome is. And so we didn't know it when they started it. We didn't know at the beginning, and now with the new judge, with the new ruling, we don't know where we are now. I'm sure there's a lot going on right there, but that's the one thing that's probably surprised. One of the things that surprised me on it is if you look at wholesalers and manufacturers, they've sort of split those higher costs between the two. And I've talked to a lot of people that rep these companies, and they'll say, and I'm surprised they didn't push it down to the consumer as much as they did. And I always ask the question, do you think they'll continue to do that? And their answer is no. They will eventually hit the consumer. And so that's the place that's probably surprised me that it didn't show up more than it has. But it doesn't affect us too much. But it's just, that would have been the only thing, I think.
Mm-hmm. This is a question I've been asking a lot of my guests lately. What is that risk for you right now that's been keeping you up at night? It doesn't actually have to be keeping you up at night, but maybe the risk that's been on your mind quite a bit that you keep thinking about.
Well, I think people, and don't get me wrong, I'm super. I'm a super American, super capitalist, everything that you want to talk about. But I think we have, as a country, have been duped into thinking we're better than we are. Militarily, we're not really the strongest. And if you look at just last week, that summit between China and Russia, North Korea, those things start to tell you that, we're in a situation now where not everybody is our friend. In fact, a lot of people are not our friend. And what makes me think about things is if you show up sometime and we misjudged a lot of that, and it'll show up in our economy, then it'll show up in our markets as well. But nobody thinks about it. I think they think, well, we're still the greatest, so they can't hurt us. But it's different out there than it used to be.
hmm And what is that one thing that's making you optimistic?
Well, I'm always optimistic for this reason, and that is if when things get harder, or people, I think in the U.S. are very resilient, and they find a way. They find a way to take to get opportunity out of adversity. I've seen it over and over and over again. So I don't rule out the fact that Americans, and especially a lot of young people, I'm impressed with a lot of young people now. I know a lot of people come down on the millennials and Zs, but in talking to them a lot, I see, I think, I think they're thinking right. A lot of them are, and I think you'll see more and more people where they'll use it as opportunity, and it gives people that maybe come from nothing or whatever, and they get a chance. Resiliency is like the code word, I think, for Americans, and it's still there. So I'm optimistic about that.
I love that. Ted Oakley, founder and managing partner of Oxbow Advisors. I always, always, always enjoy having you on the show. This audience certainly does too. It's always a treat. Really appreciate you stopping by. Thank you so much for being so generous with your time, all of your knowledge, your wisdom, helping us all learn and get better. Thanks again, and we look forward to having you on again soon.
Okay, Julia, thanks.